Good morning. For the first time in 12 months, the Bank of Canada has not raised rates. It's taken an awful long time for me to be able to get to say this, but no change at this morning's Bank of Canada rate announcement. They signaled a pause. That held true today, but it's continued to be a really flippy floppy last few months. I mean, leading into Christmas, bond yields, particularly longer-term bond yields and fixed rates, started to come down. Then between Christmas and New Year's, that trend reversed hard to the upside, and then entered January, and things softened again. Then leading into February, another surge to the upside, and that's kind of where we sit today with upward pressure on rates. Over the last 6 months, last 6 weeks, the market's gone from pricing in no hikes this year with rates to start falling later this year to a potential hike at some point between now and the fall, and rates not coming down until 2024. So not the best update on that front. So what was the reason for, this upward surge in the last month or so? In Canada, it was largely the latest jobs data. I mean, Canada added 150,000 jobs in January, which was 10 times the estimate. Imagine your estimate being off by 10 times, a multiple of 10. But that was largely driven by temporary workers, non-PR, non-citizen, workers that, was largely, brought in to fill the big job vacancy gap that we had here. So the interpretation there is, it's likely a one-time boom, not something that, we should read too much into. It's also important to note that, when an economy does slow, it's those temporary workers that tend to go back home. So not exactly, the recipe for a robust, growing economy. So TIF has signaled a pause. What could cause them to come off the bench and take action and sneak in another rate hike here? Well, the two things to watch are going to be inflation and the U.S. Fed. On the inflation front, it is positive. I mean, the latest print came in lower than expected at 5.9%, versus I think expectations were 6.1%, and that's coming down from 6.3% in December. So almost a 0.5% drop month over month. Food's still persistently high at 10.4% year over year, but who really eats food anyways? The U.S. Fed, they've recently upped their hawkishness, so that isn't good for Canada. They're suggesting a 50 basis point hike might be needed at their meeting coming up this month. And if they do that, I mean, that's going to lead to a higher terminal rate, so higher end rate for the U.S. Fed, which is going to put pressure on the loonie. It's going to put pressure on the Bank of Canada to do another rate hike. So I think that meeting's going to be, one that we'll want to pay attention to. Takeaways from today, though, are that, continues to be a really volatile year on the rate front. Things are taking longer to play out. I mean, for Canada to drop rates this year, it's going to take, a serious economic downturn. And right now that's looking like, it's unfortunately going to be, unfortunately for those looking for rates to come down, something that isn't going to happen until next year. And that's at least the outlook right now. If you have a mortgage that's coming up for renewal in the next year, I would 100% recommend you get in touch with me. One of the things we've been doing is setting up, rate holds for clients even before their mortgage renewals come up. That commits the lender. It doesn't commit you. And just given how volatile the year's been on the rate front, you have that line in the fire, and it gives you the option to take it if it makes sense to do so. So, we can hold rates for 4 months and then wait and see what happens over the next few months and make a call towards the end there in terms of whether it's worth proceeding with that. But that's it for me. Thanks for watching, and have a great day.